After studying this module, you shall be able to describe the concept of a mutual fund, understand the advantages which mutual fund offer to the investor, describe the basic methodology used in the context of mutual fund, understand various types of mutual fund schemes and their main features. Mutual fund. As per the SEBI regulations, mutual fund is a mechanism for pooling the resources by issuing the units to the investors and investing funds in securities in accordance with the objectives as disclosed in the offer document. Mutual fund is a collective investment scheme established in the form of a trust. Mutual fund offers the investors various types of schemes like equity, debt, hybrid, and money market mutual fund. Investors subscribe to the units of the mutual fund schemes and their pooled money is invested in the market as per the investment objectives of the scheme. The returns generated from these investments is distributed to the investors, obviously, in the form of dividend. Mutual fund launch various types of schemes in the market, for example, aggressive schemes, conservative schemes, and moderate schemes. Further, the investors have varying requirements, like they need growth, some want regular income, some want liquidity, and some want to save tax. To satisfy these requirements, several schemes are launched by a mutual fund, each having a specific investment objective. How these mutual fund schemes operate. In India, mutual funds is established in the form of a trust, as we have already talked about it. Mutual fund offers various types of schemes to investors, where each scheme serves a specific investment objective, which may be capital appreciation, regular income, or liquidity, or maybe tax savings. Investors with similar investment objectives will invest under that particular scheme. The small savings of these investors result in a large pool of funds available for investment in the market. Investors are allotted these units, which are called unit holders, in that particular scheme. When any new scheme is launched, it specifies its investment objectives and collects the pool of funds from the investors under this scheme. The scheme may remain open for subscription all the time or for a limited period of time. When an investor invests the funds in the scheme, he is issued the units. The face value of each unit is ₹10. Face value is important from the accounting perspective. Face value is multiplied by the number of units issued under each scheme, and it is known as unit capital of the scheme. The pool of funds collected under a particular scheme is invested by the fund manager in different instruments in the market. Depending upon the investment objective of the scheme, the funds may be invested in equities to generate capital appreciation, or in debt instruments to generate regular income, or in money market instruments to provide liquidity to the unit holders of that scheme. The scheme's investment in the market is known as assets under management. That AUM is a measure of the size of the fund, and it fluctuates as per the scheme in the value of the investments. The returns generated on the investments are proportionately distributed among the unit holders of the scheme in the form of a dividend. The mutual fund scheme may be diversified or sectoral in nature. Diversification here means allocating the funds in different sectors of the economy in order to reduce the risk. This is called risk diversification. In a normal market, all the sectors don't go down simultaneously. If one sector is performing poorly, then there might be other sectors of the economy which might be doing very well. So the portfolio diversification might help in risk reduction. The investments under the scheme will generate the income in the form of interest or in the form of dividend. The increase or decrease in the value of the investment will result in capital gain or a capital loss. These returns passed on to the unit holders, that is known as dividend, and their investments in the schemes. Unit holders also gain through the increase in the market value of the net asset value of the units. If the net asset value of these units, that is called NAV, goes up, he gets more return, and if it depreciates, he is a loser. Therefore, for the small investors who wish to participate in the affluence of the capital market and want to receive higher return on their investment, but lack the knowledge and the large amount of funds with them, for diversification, mutual funds provide a great solution. They are suitable for small investors, as the small savings are pooled together, and such large corpus is managed by best qualified fund managers and invested in the market to generate higher return, though there might be some higher risk involved along with. The mutual fund launches various schemes from time to time in order to attract various types of investors. Each scheme has a specified investment objective like regular income, tax saving, or growth. A mutual fund is required to be registered with the Securities Exchange Board of India, known as SEBI, which is the capital market regulator, before it can mobilize funds from the public. Now, what are the advantages of investing in a mutual fund? There are many of the advantages, as we mentioned, by investing in the mutual funds. First of all, there is a professional management. Investing directly in the equity is very risky for those who are not expert and lack the ability to track the market regularly. Therefore, mutual funds are excellent investment schemes for them. These mutual funds are managed by professionals with adequate qualifications and experience. Their in-house research is undertaken to aid the fund manager. The top management is also involved to guide the investment policy and the fund house philosophy. The competitive performance resulting in the constant improvement of the portfolio and the NAVs are disclosed at record timings. Another benefit of mutual fund investment is diversification. Diversification is nothing but investing your money across different types of investments. An investor with a limited amount of money may not be able to invest in one or two stocks or bonds. However, a mutual fund invests in a number of companies across a broad section of industries and sectors. This diversification reduces the risk because it is unlikely that all the stocks might decline at one single time. So unit holders of a mutual fund achieve this diversification benefit with very less amount of money invested, and they cannot do it otherwise on their own. Another important benefit is the lower cost. As mutual funds invest huge amount of money on a regular basis, they pay a very small amount of commission as brokerage, the depository fee and the other type of charges as compared to any other individual investor. So mutual fund is a cost-efficient mechanism of investing in the markets. Transparency. Mutual funds have to publish their NAVs on a daily basis, and they have to do it periodically, sharing the portfolio investments with all the investors. They offer transparency to the investors and have to publish their returns semi-annually. Any important change in the scheme has to be duly informed to all the investors. Attractive return is another advantage. Mutual fund gives very attractive return in a long period or a medium period because fund managers invest in stocks after considering the fundamentals, future plans of the companies, which help the trained research teams. They use every possible technique to save the investors' money, such as hedging. So it's very important and a good investment avenue used in financial planning process. Mutual funds are very well regulated. All the mutual funds have to be mandatorily registered in India with SEBI. SEBI Mutual Fund Regulation 1996, as amended until now, governs the mutual funds operations and their investments. The regulatory system aims to ensure the protection of the interest of the investors. The fund investment have to be as per the scheme's objectives, and there has to be complete transparency about the funds invested and their performance. Net asset value of the fund has to be published on a daily basis, and the scheme's performance must be published periodically. SID and SAI contain all the relevant and important information pertaining to the scheme and the fund, and serves as an important investment instrument for the investors. Therefore, the mutual fund is a very well-regulated investment vehicle in India. Now, there are various choice of options which are available in the mutual fund. In India, mutual funds offer different types of schemes to suit the varying needs of the investors. The investors have different goals, different objectives, which may range from, say, retirement planning to invest in a vacation, or investors' needs may include capital appreciation, or maybe liquidity or regular income. Because of the several types of the schemes launched by the mutual fund catering to the different investment requirements, investors have various options to choose from a wide range of schemes such as growth plan, regular income plan, or equity oriented plan. It may be gilt-edged plan too. They have the choice available in their method of investment too. They can invest in one single go, we call it lump sum money, or they can opt for periodic investments in the form of monthly installments through systematic investment plan, SIP schemes. Similarly, they can opt for a single withdrawal of the entire funds they have in their mutual fund scheme, whensoever required, or may adopt monthly withdrawal plan. The liquidity in the mutual fund is also excellent. Open-ended mutual funds are very liquid investments because investors in open-ended schemes are all the time available for redemption or subscription with the fund itself. Investors can enter and exit from the scheme at any time of their preference at the prevailing net asset value price. The closed-ended schemes, however, offer very limited liquidity to the investors. Investors can buy these units from the NFO and can exit at maturity, but they can do that exercise of liquefying it by selling in the stock markets. All the closed-ended schemes have to be necessarily listed on the stock market as per SEBI regulations. This provides a secondary market exit route to the investors of the closed-ended schemes. Although the schemes are listed, but practically trading volume in closed-ended mutual fund schemes is generally limited. So therefore, there is slight problem of liquidity in case of closed-ended mutual fund schemes. It's a convenient method of investing. Mutual fund provide very easy and convenient way of investment as well as withdrawal of the funds as compared to any other investment avenue like real estate or even the bond instruments. Investor can invest in any manner either through a distributor in a physical form or can buy directly online whatsoever is convenient to him. Units can be held in demat form or in physical form. The price at which investors buy and sell the units of the mutual fund is called NAV. The mutual fund compute this NAV on a daily basis or even twice a day. Some of the mutual funds happen to do it. NAV of a mutual fund's unit keeps changing because it is dependent on the value of the real assets which the mutual fund is having in that respective scheme. Net asset value of the scheme is calculated by dividing the net assets of the total scheme by the number of units of that scheme, where net assets means all the scheme's investments, accrued income, etc. minus outside liabilities of the scheme. If an investor sells the units, then he receives the net asset value linked price from the mutual fund. Now, which is net asset value minus the exit load. Net asset value therefore is market value of investments plus accrued income minus accrued expenses. All total deducted from that is the liability. That gives us the net asset value. Divided by number of units and you end up with net asset value per unit. The investments made in the scheme earn interest or dividend periodically or realized gain or which may be loss. Now when the market value of these investments held under the scheme go up, they are called unrealized gain, and if they happen to go down, they are unrealized losses under the schemes. Further, every scheme has its share of expenses, for example, investment management fee, etc. This scheme investment is said to be in profits if the following metrics results into positive value, which is interest plus dividend plus realized gain plus unrealized gain minus unrealized capital loss or unrealized valuation loss minus scheme expenses. This will give us the net asset value. If it is positive, that means the net asset value has gone up over a period of time. Investors under a scheme have several options to receive the income in different forms. They are growth option, dividend payout option, or dividend reinvestment option. is an option where the return or the profits earned by the mutual fund is plowed back in the mutual fund scheme itself, and hence investors are not paid any dividends. Since there is no declaration of dividend, the net asset value increases rapidly, which is a good sign for the fund. In such a case, investors can sell their mutual funds at a higher NAV and get a return. In this scheme, the fund will distribute the dividend periodically. Under this, the profits of the mutual funds are distributed amongst the investors at various intervals. It is not mandatory to declare the dividends. When there are profits, then only dividends will be paid, otherwise not. It is also dependent upon the mutual fund manager's decision as to when and how much dividend is to be paid. The net asset value is reduced by that amount dividend unit distributed under the scheme. Obviously, as the name itself signifies, is one where the dividend is declared but reinvested in the scheme at the ex-dividend NAV. This will give rise to increase in the number of units in the hands of the investors. Therefore, instead of receiving the dividend in the cash form, the unit holder is receiving units at ex-dividend NAV. Therefore, the number of units with the investor will go on increasing as the dividend is getting reinvested. Types of mutual funds. Open-ended mutual fund scheme. An open-ended scheme is open for sale and repurchase all the time from the fund itself. It means that investors can at any time enter into the scheme and exit from the scheme at the NAV minus the exit load. If investors buy the unit during the NFO, that is when the mutual fund is initiating the scheme, then the units will be issued at the face value. Therefore, the investors in the open-ended schemes offer a great liquidity. You can enter and exit at any point of time of your own convenience. The unit capital of open-ended scheme, therefore, is going to be fluctuating in nature because regular sale and repurchase by the fund will be bringing about this kind of a change. On the contrary, the closed-ended mutual fund scheme has a fixed maturity period, which is generally 3 to 5 years. The scheme is open for subscription only during the NFO at the face value, and at maturity the fund will redeem all the unit holders the mutual fund NAV based redemption price. During the tenure of the scheme, entry and exit is closed by the fund. Nobody can enter, nobody can exit after the fund has closed. But in order to provide exit route to the investors of the closed-ended schemes, SEBI had made it compulsory that these units must be listed in the market, which should be nationwide stock exchange. However, this listing in closed-ended scheme generally has a problem. It doesn't provide much liquidity because there is not much trading in the secondary market in these kind of units. Equity funds. Now, these are the mutual fund schemes which invest a major chunk of their corpus in equity shares of the companies. Therefore, they are exposed to market fluctuations and offer no guaranteed payment of dividend. They are bought and sold at NAV based prices, which is considered very risky. There are several types of equity fund schemes like Diversified Equity Fund Scheme. The Diversified Equity Fund Scheme, as the name itself signifies, it's an investment in a wide variety of stocks. Their diversified portfolio includes stocks from various industries. The diversification leads to reduction of risk. Now, there can be an investment in a sector-specific fund or a scheme. Now, these are known as sectoral funds. Sectoral funds invest the entire corpus in one single specific sector with the expectation that the sector will perform very well and the value of the entire portfolio will go up. For example, a sector fund may invest the pool of the fund received from the investors under a scheme called FMCG sector or a banking sector. They offer highest possible risk return combination to the investors. Higher the return, higher the risk. If a chosen sector performs as per the expectation, then the value of the investment goes up. Else, investors' entire fund loses its value. This does not happen in a diversified fund, in which if one sector performs well, the other sector may not be performing well, it gets counterbalanced. Thematic funds. These funds invest in stocks of related sectors belonging to a particular theme. Say for example, infrastructure fund will invest in power, steel, cement and related sectors. Their portfolio orientation is broader than the sector funds but narrow in comparison to the diversified funds. Therefore, they are riskier than the diversified funds but safer in comparison to the other sectoral funds. Equity linked saving schemes. Now ELSS basically imply equity linked saving scheme with a purpose to save tax. It's a diversified equity fund and investment in this scheme will fetch tax deduction under section 80C of the Income Tax Act. An ELS fund operates much like the plain equity fund. There is not much of a difference, except that your investment is locked in for 3 years. ELSS funds come with all the usual trappings of any other equity fund, which include choice between dividend and growth, systematic withdrawal plan. So in very simple terms, it's a mutual fund with tax benefits. Here one point is important to be learned, that the money will remain invested at least for 3 years. ELSS schemes may be open-ended or closed-ended. If the scheme is open-ended, then scheme is open for entry and exit all the time. But a particular investor can exit only after the completion of 3 years, as I mentioned. Therefore, those who have not completed their 3 years can't exit. If the ELS scheme is closed-ended, then the investor will enter during the NFO and exit only through redemption by the fund at maturity, which has to be minimum of 3 years. Equity income or dividend yield. The equity income funds own stocks of well-established companies, but they pay dividends. Therefore, equity income funds tend to be somewhat conservative and show less volatility than stocks of the growth fund schemes. Equity income funds are well suited for conservative investors because they are less volatile. In an equity-oriented fund, the fund will be seeking to provide regular income as well as long-term capital appreciation. By investing in stocks of well-established companies that have a current or potentially very attractive dividend yield. Now there can be a scheme which is investment purely in the index, known as equity index fund. Let's understand that. Equity fund is a passive fund in which the fund manager will create a mirror image of the portfolio of a particular index. For example, BSE Sensex or BSE Nifty will be totally mirrored, or it will be a replica of that. Fund manager invests in stocks of the selected index in the same proportion as that of the index. He will regularly track the index and modify the portfolio if there are changes being made in the composition of the index. Net asset value of such schemes would rise or fall in accordance with the rise or fall of the index. Any difference in the fund performance and index performance is known as tracking error, which is caused by any lag or error in the following of the index by the fund manager. These funds usually give the same return as the respective index do. However, the return can be more or less than the return of the respective index, which is reflected by the tracking error. This difference is contingent on the skill of the fund manager to track the index movements. The debt funds can be another great opportunity for assured return. Debt funds aim to provide safety and regular income to the investors through investing in the fixed income instruments like government bonds, government debentures. The periodic interest received on these bonds is used to provide regular income to the unit holders in the form of a dividend. These funds are considered less risky in comparison to the equity funds. However, the net asset value of these funds is influenced by the market interest rate movements. If the interest rates happen to go up, the net asset value of these funds will decline, and vice versa. If the investors plan to exit at any maturity of the scheme, then he is not affected by these kind of movements temporarily. There are several types of debt funds. For example, there can be diversified debt funds. Diversified debt funds invest the corpus of the scheme in the debt securities of various sectors and in the government as well as corporate debt instruments. Because of the inherent safety of the debt and added diversification, these schemes are considered to offer moderate to low risk and the return to its investors. Lesser the return, lesser the risk you are envisaging. High yield debt funds. High yield debt funds are the mutual fund schemes which will be investing in the below investment grade bonds with a rating of BB or lower than that even. Because these bonds are quite risky, therefore in order to attract the investors, they offer high yield. Therefore, in spite of the debt instruments, these schemes offer very high risk return to the investors. The NAV of these schemes is quite volatile and the scheme's portfolio has high default risk, in turn the high return. There can be a scheme which is known as fixed maturity plan. These FMCs are closed-ended schemes issued by the mutual funds and they mature at a fixed maturity date. It could be 15 days, 30 days, 180 days or 365 days. Some even have a 3 or 5 year of time frame. At the end of the period, the scheme matures just like a fixed deposit. FMC will invest in the fixed income instruments like government bonds, government securities, money market instruments, short term as well as long term. The objective of the FMC is to generate steady return over a fixed maturity period and protect the investors against the market fluctuations. FMPs are typically passively managed fixed income schemes with the fund manager locking into the investments with maturities corresponding with the maturity of the plan. Floating rate debt funds. These funds invest in floating rate debt securities. For example, rate of 10-year GSEC plus 1%. Their NAV will fluctuate less than the debt funds investing in the fixed rate instruments because their coupon rate moves in line with the market interest rate. Yield funds. Now the yield funds are the name itself implies are the schemes which invest in the safest debt instruments. These schemes invest in the long-term government bonds which do not have any risk of default. However, these long-term bond prices are also affected by the general interest rate movements and follow an inverse relationship. Thus, the NAV of the yield fund goes down when the interest rate happens to go up in the market, and vice versa. A short-term investor has to be very careful about these kind of movements. Money market or liquid fund. Money market mutual fund are funds which often are used by short-term retail investors or corporate to park their short-term surplus funds. These funds offer highest safety of the principal and liquidity of the funds to its investors. These funds invest the investors' money in safe and liquid debt instruments like certificate of deposits, commercial paper, call notice money, and the other instruments of that kind. These instruments are quite safe and have negligible default risk. At the same time, they have very short maturities and therefore are not much influenced by the interest rate movements because in such a short time, there is very low probability of adverse interest rate movements on the prices of these bonds. Therefore, money market mutual funds are considered the least risky amongst all the mutual fund schemes. Now, there can be hybrid funds. These hybrid funds are funds which allocates the funds in equity as well as debt securities. There are various types of such funds like a balanced fund. Balanced fund, also known as hybrid fund, aims to provide an investor the capital appreciation of the equity as well as the regular income and safety of the debt instrument. They invest the pool of the funds received from the investor under the scheme in a judicious mix of equity and debt instruments. The perfect balance will be 50% of the corpus in debt and 50% in equity. An equity-oriented balanced fund will invest more than 65% of the corpus in the equity, whereas the rest of the money will be invested in the debt. On the other hand, the debt-oriented balanced fund will invest more than 65% of the corpus in the bonds. Thus, they offer moderate risk and return to the investors. Now, there can be monthly income plan kind of a fund scheme by any mutual fund. In this case, the investment objective of this scheme is to distribute dividend among its unit holders on a regular basis, say every month. It therefore invests largely in debt securities, say 75 to 80% of the corpus, so that the periodic interest received from such debt instruments can be used to declare regular dividend. However, a small percentage is invested in equity instruments to improve the scheme yield. There can be funds like Capital Protection Fund. These Capital Protection Fund is a scheme whereby the AMC safeguards the capital invested by the investor, irrespective of the fund's performance. These schemes ensure capital protection for the investors by investing in government securities with no risk of default. A calculated portion of the corpus is invested in these fixed instruments to ensure capital protection and the balance in the equity for some capital appreciation in the portfolio. This calculated portion is decided by applying the time value of the money concept to the returns received in the fixed income instruments. For example, let us assume in a capital guaranteed scheme, a person is investing rupees 10,000 and the scheme is a closed-ended scheme for 3 years. After 3 years, he has to be given back at least rupees 10,000. The fund will be investing rupees 7,939 in a debt fund generating a return of 8%, which will provide 10,000 after 3 years. The rest of the amount, say 2,062 rupees, will be invested in the derivative market to generate good return, or at the most it may remain 2,062. If it remains 2,062, the investor will get back 10,000 original amount plus 2,062. That means 12,062, which gives a return of 6.45%. Now, there can be a desire of the investor to diversify a lot. For that, there is a fund called Fund of Funds. A mutual fund which invests the pool of funds collected from investors under the scheme in other mutual fund schemes is called Fund of Funds. Just as a mutual fund invests its funds in different securities like equity, debt, etc., a fund of fund holds units of other different mutual fund schemes and cash or money market instruments. A fund of fund permits investors to achieve higher diversification and suitable asset allocation with investments in various fund categories that are all packaged in the form of one fund. However, if the fund of fund carries an operating expense, the investors are essentially paying double for an expense that is already included in the expense figures of the underlying funds. Let's summarize. Mutual fund is an investment avenue which gives all the small investors an option to participate in the capital market with the small funds with them and a limited knowledge of theirs. And the markets are volatile, they can't manage the funds on their own. Mutual funds collect the small sums of money from a large number of investors. This becomes a large pool of money which is invested in the market, and the returns generated are distributed amongst the investors proportionately. In India, mutual funds offer different types of schemes to the investors. The mutual funds are well regulated by the provisions of SEBI Mutual Fund Regulation 1996. Mutual funds are largely classified as open-ended mutual funds and closed-ended mutual funds. The unit capital fluctuates depending upon the subscription of the units by the investors in the open-ended mutual funds, and they don't have any fixed maturity period. It remains open for the investors for all time. The closed-ended funds, on the other hand, have fixed unit capital and a maturity period, and that remains open for the investors only for a limited period of time, which is known as NFO, new fund offers. There are four major categories of mutual funds, largely equity, debt, hybrid, and mutual fund, which are money market mutual funds. The following diagram describes the risk-return characteristics of different types of mutual funds. Whereas the liquid funds are perceived as least risky and offering the lowest returns, the sectoral funds offer the highest returns, though at the cost of huge risk. Therefore, schemes have varying risk-return profile, which may be categorized as high, moderate, or low risk-return combinations, as shown in this figure.